First of all, thanks everyone for joining us in person and online for our Investor Day presentation. I'm Brian Newmarch, Vice President of Capital Markets here at 7Gen. For those in the room, just a heads up, today's presentation will be webcast simultaneously as well. So we feel that this Investor Day is an important opportunity to expand on 7G's strategy and the rationale behind the budget that we released this morning. Today, we'll provide an update on our business, our operational progress, and our multi-decade asset base. This is also a chance to hear directly from our senior management team on our strategy, and it may be the first chance that you've heard in person from David Holt, our Chief Operating Officer, who joined us in May, or Derek Aylesworth, our CFO, who joined us back in March. Flipping ahead to page 2 on the agenda here, we will make this succinct and to the point. Marty will walk us through 7G's strategy and key objectives before passing things over to Derek, who will elaborate on our 2019 capital allocation plan. David will share his views on operations and the progress that we've made. And then Chris and Lynn will wrap up with a planning and resource update. Just a few quick formalities. We ask that questions are held to the Q&A session at the end of the formal program. We will also have members of the entire management team who's sitting at the back of the room available for further discussion if you're interested after the presentation. For anyone listening in on the webcast, if you'd like to ask a question, feel free to shoot me an email. We'll try to get it addressed. My email address is on our website. Lastly, I'll also remind everyone that all comments made today are subject to the legal disclaimers found in the back of today's presentation, as well as in this morning's press release. Both are available online. With that, I'll pass things over to our President and Chief Executive Officer, Marty Proctor.
Thank you, Brian. Good morning, everybody. I'm first going to talk about the mission of the company. In the simplest terms, our mission is to build a sustainable business that delivers predictable and compelling returns to our shareholders. In more detail, we want to serve our stakeholders through differentiated attention to selection, development, and replenishment of the lowest supply cost resource, best-in-class execution through safe and responsible, innovative, and efficient development, maximizing profitability by proactively securing access to premium-priced markets, and maintaining an unwavering focus on balance sheet strength. The foundation of our business is strong. We have a knowledgeable and skilled staff. We have amassed a large and high-quality resource, and we have a very strong balance sheet. We have complete control over our operations as well, and we have a big infrastructure built to support those operations. We just completed our third owned processing plant, a 250 million cubic feet per day processing plant at Gold Creek. That brings our owned processing capacity to more than 750 million cubic feet per day, more than we need at this time, enough to satisfy all of our growth ambitions. But we're looking now through a process that we initiated late last year to see if we can generate a new revenue stream from that excess processing capacity. So we've got that strong foundation. The resource is also strong. We'll talk about it quite a bit through this presentation today. 800 sections, more than 500,000 net acres of Montney rights, and a high-quality inventory, and now a base of production, more than 200,000 BOE per day, that delivers a lot of cash flow. And so on the left side of that lever, building on that strong foundation, are the cornerstones of our strategy, and they relate well to what I had said in the mission, first being stakeholder service, next being low supply cost, next being market access to premium price markets, and finally, and most importantly, financial sustainability. I've got a few slides following that'll talk more about those specific cornerstones of our strategy. But what those do for us, they lever us into a position where we have free cash flow. This year we'll have discretionary cash that we're choosing to invest in delineation drilling and some infrastructure. That discretionary cash is about 12% of our budget plan. We are able to generate, and we've been generating good returns on capital employed already through Q3 of last year, 15.6% ROCE. We intend to have return on capital employed still in the 10 to 15% range go forward. And beginning in the fourth quarter last year, we began to return capital to shareholders. We implemented a normal course issuer bid. Through that NCIB, we purchased 9.7 million shares of the stock, about 2.7% of the stock, for about $10.72 on average. So we've got those tools in place now for the future as well. So the first cornerstone of the strategy that I mentioned is the stakeholder service, and this is our guiding principle. This is why we exist. We exist to serve our stakeholders. We've named the 7 key stakeholders that we have, and of course, you, the shareholders, are a very key stakeholder for us. This is a map covering a large area. This is showing most of the provinces of British Columbia and Alberta. In the center, the shaded area, is the Montney. The Montney is a giant resource. It spans about 700 kilometers from the north to the south, about 150 kilometers from east to west. It's estimated to contain about 90 billion barrels equivalent of marketable resource, which is about half of the oil sands, half of the marketable resources expected from the oil sands. So the Montney is a formidable resource. We are positioned in the southwest part of the Montney. You can see that in the yellow in the bottom of that shaded area. As I said, 800 sections, more than 500,000 net acres of Montney rights. We happen to be in a geologically advantaged position in the Montney as well. Where we work, it's fairly deep, over 3,000 meters, and high pressured. It's thick, about 200 meters thick. The Montney is actually a high quality rock as well. It's not a shale, it's a dolomitic siltstone, therefore it fractures very efficiently. And where we are, for the depth, as I said, over 3,000 meters, it's actually relatively cool. So we have not cooked off the liquids, and we have not generated H2S. So we have relatively sweet gas with very high liquids yields. We have been producing about 59% liquids and about 41% gas from our development to date. So a very strong geological position. Also, as you can see in this map area, a very strong geographical advantage as well. So we are positioned 100 kilometers south of Grand Prairie, which is a city that's been very supportive of the energy business for many, many years. We work off of a paved highway. We build high quality roads to that highway and good pads where we can drill and do our work year round. There's 2 transcontinental pipelines that cross through our land, both the Alliance pipeline and the TCPL systems. We have secured long-term access on those pipelines to get our gas to premium markets, and I'll talk about that a bit more in the future or in the next few slides. We also have a rail going through the land, so we have rail access for potential future solutions. And we're in very, very close proximity to the biggest demand point for condensate. So as I say, 59% of our product is liquids. In that 59%, 37% or so is condensate. And the market for condensate in Canada is very strong. In fact, the market for condensate is about double. The demand for condensate is about double the supply of condensate in Canada. So we achieve a very good price for our condensate. And I'll come back to that. There was a bit of a dislocation in condensate prices in the fourth quarter. That seems to have recovered. We contributed to it, and that's part of why we've got a bit of a flat profile plan for this year in our production plan. But we still anticipate very good prices for the condensate for the foreseeable future. This shows a little more detail on our land holdings. Again, this spans a fairly large area. It's about 70 kilometers from east to west, about 55 kilometers north to south. Each of the squares is a township, which is about 10 kilometers by 10 kilometers. So again, we have 800 sections of Montney rights. We also have, which is about more than 500,000 acres of Montney rights. Our core development, our team has done a tremendous job understanding the geoscience, the reservoir engineering, the production engineering better than ever. And you can see how we've now kind of color-coded how we see the nest locations, nest 2, nest 1, nest 3. We understand them better. We can be much more predictable with respect to our forecast for production. And we can also direct our capital to areas where we get more or less liquids, more or less gas. And we can even be more selective in how we apply our completion techniques. And David will be talking about that a little bit more later. In that core area, the nest area, nest 2, nest 1, nest 3, we identify about a little more than 600 locations in nest 2, about 500 locations in nest 1, about 200 locations in nest 3. We are working to expand that, and Lynn will be talking about that a little bit later with her talk. But we've got about 1,300 core locations, which represents, at today's drilling pace, about 15 years of inventory of the top tier asset that we have. And we're working to expand that inventory. So we've had some success in 2018 in the lower Montney. We intend to invest in about 5, maybe even up to 7 lower Montney tests in the coming year. Lynn will talk about the plans for that. But that lower Montney has a lot of potential to expand our inventory. Our work in the west part of the Nest 2 area, which again Lynn will talk about, has the potential to expand our Nest 2 area. And our work in Nest 1 will help to improve our understanding there to the point where we think we're going to be able to show a significantly better type curve, better economics in that Nest 1 area. So a strong area of core development, a lot of expansion of our inventory to come, a lot of work ahead that we're confident is going to improve and continue to show our stability and sustainability. Also shown on this map, I just want to touch on it again. I mentioned it before. We now have 3 of our own processing plants. Off to the east side of the map is our Latour processing plant. In the north part of the covered region, in the north part of the Nest area, that's our Cutbank plant. And in the very top center of this whole map space is our new Gold Creek plant. And that's one that we just built. It has access to both. We're connected to both the TCPL line and the Alliance pipeline. We also have a rail right beside us there. This is the plant that we set out to see if we could get a partner with, to see if we can find a way to create an enhanced revenue stream from that asset. So that's a kind of a closer look at the assets that we have in place. The second cornerstone of our strategy I mentioned was the low supply cost. And this is some work by RSEG, some work that shows break-even supply costs. It's trying to identify for all of the resources in Canada who's got the best break-even supply cost. What it does is track the Henry Hub gas price needed to generate a 10% rate of return, assuming a $60 WTI price. It's a complicated chart. It's all the dots represent a well, and they projected from those wells what the break-even gas price would be. And there's an average for all of those wells shown. And our Nest area, our Nest 2 area, is shown on the far right with a break-even supply price of less than $1 an MCF with those assumptions. So we've got one of the best assets in North America. We are, as I say, working to expand our inventory of development opportunities, bringing forward more economic value in the Nest 1, bringing forward more value in Nest 3, identifying additional opportunities in the lower Montney and other areas, even in the Wapiti region or the Cretaceous region. All those are going to continue to feed that hopper so that we will continue to fulfill that objective, that strategic cornerstone of having the lowest supply cost. This, I might have missed one here, just a second. This is the third cornerstone of our strategy. This goes to market access. All of our product, all the product that we produce exists as a gas in the reservoir. But when we depressure it, liquids come out of that gas solution. And as I said, when we get it to surface at atmospheric pressures, we end up with about 41% gas and about 59% liquids. The condensate is the most valuable product that we have. It generates about 70% of the revenue that we sell. The gas less revenue, maybe 30%, up to 30%. But we can't sell any of the products unless we can move all of the products. As a company, we've been very, very proactive since the beginning, securing access to premium price markets for our natural gas. We can truck liquids. We can't truck gas. It must be pipelined. And so for many years, we've been very proactive. We now have 500 million feet per day, 500 million cubic feet per day of capacity on the Alliance pipeline to take our gas from our project area to Chicago. We take about 100 million cubic feet per day of that to Henry Hub. We have access on the Trans-Canada Mainline to take about 80 million cubic feet per day to Dawn. And later this year, we'll have access to Malin on the GTN line to take about 90 million cubic feet per day to Malin. And with that diversified access, we've been able to get very good prices for our gas. In Q4, our natural gas price was $4 to $5 per MCF. So that's an advantage for us, obviously. It differentiates us. And again, to go back, I mean, one of our most valuable products is the condensate. We've got a great market for condensate right next door. And this chart shows the demand for condensate versus supply. The top part of it shows total demand in the oil sands region. Currently about 600,000 barrels per day of demand for condensate. And the green at the bottom of that upper chart shows the supply of condensate in the Western Canadian Sedimentary Basin. And that supply is far lower, about half of the demand. So that demand, the extra demand that's not supplied in Canada is made up, it's met by bringing up condensate on the Cochin pipelines or condensate on the Southern Lights pipeline, or even condensate comes up by rail. The chart on the bottom is attempting to show the implied condensate imports required to meet the demand for condensate in Canada. And what it's indicating is that by mid-year this year, we anticipate having demand for condensate exceed the supply on the pipelines. And so the rest will have to come on rail. Therefore, we see condensate pricing continue to be very strong. We are now Canada's largest condensate producer. We produce about 20% of that green band. So now I'll just quickly outline our 2019 budget. The rest of the team, Derek, David, Chris, and Lynn will be talking about this in more detail. But as a quick outline, we promised, and now we're going to deliver, a cash flow budget in 2019. At $50 WTI, we anticipate cash flow to be around $1.25 billion. So that's our intended investment this year. About $1.1 billion of that will be to sustain production. So it'll keep production relatively flat to 2018. That is around 200 to 205,000 barrels equivalent per day. 12% of the budget, about $150 million, will be targeted to expand our inventory through delineation drilling in the Lower Montney and other areas, and about $25 million of that will be invested in infrastructure projects and optimization work and workovers that are going to enhance our profitability. So that's the outline of the budget plan for 2019. I want to go back now to the fourth cornerstone of our strategy, and that is financial sustainability. So as I say, we predict funds flow of about $1.25 billion in 2019 at a $50 WTI. As we committed in the past, we intend to invest no more than our funds flow in 2019. So that means $1.1 billion for sustaining capital and 12% of the budget for these other projects that I mentioned, delineation, drilling, and infrastructure. We had choices. We could have chosen to take that 12% and direct it to growth. If we invested 12%, $150 million in growth at our historical capital efficiencies, that would result in growth of 6 to 7% this year. We didn't think it was prudent to invest in growth at a time when commodity prices are challenged. We don't think it's prudent to burn our top-tier inventory at a time when commodity prices are challenged. And also, there's an abundance of supply in Canada. So we thought it was more prudent to direct that capital investment, that $150 million, to projects that are going to create an improved net asset value for the company. We have complete flexibility and control over how we invest our capital. We can reduce capital if necessary. If commodity prices erode, we could reduce our delineation drilling. We could reduce that infrastructure investment. We could, and we will, get more efficient at even executing our sustaining program. But we also have flexibility if commodity prices improve, and we have tools in our kit, including the NCIB. We could continue more share repurchases. We could add a little growth. We could invest in more delineation drilling, and we could invest in more infrastructure. We have complete control and the ability to react to market circumstances. We have a strong balance sheet. Our leverage through Q3 last year was about 1.2 times debt to cash flow. We have liquidity of about $1.4 billion, an undrawn line of credit, which we just renegotiated and I think improved the terms on. And we've got a risk management program that guarantees a certain level of cash flow. It's a disciplined, objective risk management program. We currently have about 40 to 50% of our condensate hedged for the 2019 year at 62 to $78 WTI. So a very, very strong financial position, matching that fourth cornerstone of our strategy. So we want to revisit our commitments. What did we say to you on November 16th, 2017 about the 2018 program and about the 2019 guidance? Well, we said we'd have organic growth in the 7 to 14% range per year. We said we would have return on capital employed of 10 to 15%. We said we'd have a net debt to cash flow ratio below 2 times. We were targeting a funds flow budget for 2019. That is a balanced budget for 2019, even at $55 WTI. And we had a forecast for more production. We had a forecast for 220,000 to 240,000 barrels per day of production in 2019, which we predicted then would be at a 55% condensate or 55% liquids ratio, which would have been about 75,000 barrels per day of condensate. So did we deliver what we promised? So in 2018, our production averaged about 202,000 barrels equivalent per day, certainly within the guidance range that we had intended. And in fact, we chose at the end of 2018 to defer the startup until January of 7 wells that we had drilled, completed, and tied in November. We chose to defer the startup of those 7 big wells till January so we could get a much better condensate price. And it's significant. We're talking about an extra $20 per barrel for the condensate in January. So we felt we had delivered what we had committed production-wise. We thought we could work on getting more value for our shareholders by pushing back the startup of those 7 wells. So we delivered that production that we had guided. That was our original guidance. And we delivered that within the capital guidance range, which was $1.675 to $1.775 billion. So our capital spend in 2018 is within that range. Our plan for the coming year, the $1.25 billion spend, or capital investment, is about $500 million less than 2018. And that is because we want to live within cash flow. The fourth bullet there, we are targeting a funds flow budget now even at $50, even though our commitment was made at a $55 WTI expectation. So we've delivered, as I said, the return on capital employed that we promised, the 10 to 15% range. We've got the debt to cash flow ratio at the low end of our intention, certainly well below our target of 2 times. But we did not deliver the production growth that we had intended. The WTI price is lower. The market is overwhelmed by supply. We believe it's more prudent for us to defer that growth, manage our business better. We think that the program that we have intended this year will actually have a couple of very positive results. One is we'll mitigate the decline. Our declines that are currently existing will come down as we go through the year and add fewer new wells to the mix. And through time, as we execute even more efficiently, we're going to create more value for the company. So we believe we delivered what we promised in 2018, and we're on track still to deliver what we promised for the future. And David will be talking more about our operational excellence and execution in short order. So today's takeaways, what you're going to hear, what you've heard from me, what you'll hear from Derek, David, Chris, and Lynn, is that we are expanding our inventory. We are improving the economics of our Nest 1 area. We have, through that NCIB that I talked about and that Derek will talk about further, we have, through that NCIB, created a tool in our kit that can generate per share growth that's meaningful, and it will create value for our shareholders. And the program that we have outlined for 2019 will help us to be even more efficient in the future. We anticipate significantly more free cash in 2020 when declines are lower and we have less investment in infrastructure. So just a couple of highlights. So as I mentioned, we are expanding that discretionary free cash. This year we have chosen to invest that discretionary free cash in delineation drilling and in some infrastructure activities. That's about 12% of the program this year. Next year we expect free cash to be even significantly higher, even at $50 to $55 WTI. We are achieving what we promised. We have diverse marketing and price differentiation. We're actually getting revenues in US dollars like a US company, but our costs are in Canadian dollars. We have a high quality resource and a deep organic drilling inventory, and we have financial strength, flexibility, and liquidity. I'll ask Derek to come up now and then continue to discuss the 2018 or 2019 budget.
Thanks, Marty. My name's Derek Ellsworth. I've been the Chief Financial Officer for the company since March of last year. Because this is my first Investor Day, I thought it worthwhile to note some of my not so new now observations about the company. I'll keep my observations to the above ground realm because David's going to follow with his observations from a more technical perspective. From a pure finance point of view, I inherited a great profile. The company's been well capitalized, with the appropriate debt levels being thoughtfully constructed, with an undrawn bank line which offers lots of liquidity sitting on top of term debt. Of course, any finance profile is a function of its underlying business, and there again, I came to an attractive place. 7G had the foresight to establish egress solutions to support its growth ambitions and was well ahead of most of its Canadian peers in doing that. That foresight is today resulting in a revenue stream which is higher and less volatile than many of our peers, and this is one of our strategic differentiators. Neither the finance plan nor the marketing plan is worth much if the rock isn't there, and that ultimately is our biggest competitive advantage for our company. Others can speak to the below-ground science more clearly than I can, and you'll hear from them today. I can observe that we consistently drill the most prolific wells in Alberta, and even an accountant can know that's a good thing. I've been impressed with the quality, both personal and professional, of the people that I get to work with here every day. It's a privilege to have this opportunity. Since I'm sure you're all out of tissue with your crying into, I'll focus the balance of my comments on our 2019 capital budget and the thinking that led to our capital allocation decisions. Any capital allocation process needs to begin with the macro environment, and that's exactly where we begin. We continuously apply scientific rigor to understand and evaluate our portfolio of investment opportunities, and in the context of the prevailing environment, focus our capital on those projects that generate the best financial returns for our shareholders. Our capital allocation is an input to our plans. Production per share and cash flow per share growth are outputs. We're focused on maximizing financial returns over the long term. We believe that over the long term, total shareholder returns are enhanced by a focus on ensuring that the underlying business remains sustainable and less volatile. By that, we mean that the business is able to continue to deliver positive returns through a variety of commodity price environments. From a financial perspective, I see the three legs of the sustainability stool. And yes, that is a stool. One of the first things that got cut was the finance group's graphics budget. Three legs are capital efficiencies, which is the cost over the long term of adding our productive capacity. Netbacks, which is the net revenue which we earn when we sell our production and which funds our ability to continue to meet our business objectives. And decline rates, the rate at which current production declines without additional investment. Much of our capital investment in 2019, directly or indirectly, will serve to strengthen one or more of these legs. Our current capital efficiencies are industry competitive and have the potential to naturally improve as our infrastructure investments are behind us. We're investing in delineation of our asset base in 2019 to ensure that we replenish our inventory of top-tier drilling locations at the same time that David and his team are focused on ensuring we continuously seek to improve our cost structure and technical plans. Our liquids focus generates premium netbacks with an operating cost structure which is similar to a traditional natural gas producer. We continue to make investments in netback enhancing water handling solutions which have some of the best individual project economics in our inventory. As Marty mentioned, our current decline rates are higher than we would like them to be, largely as a result of our historic pace of growth. We expect decline rates to moderate in 2019, both as a result of proactive field pressure management and debottlenecking projects and from natural decline moderation. A combination of improving capital efficiencies and lower decline rates will, over time, lower our sustaining capital requirements, which lowers our break-even commodity pricing and makes us even more resilient through various price cycles. When we speak about a returns focus, we're not narrowly speaking about well economics. We're talking about a business plan that ensures we build a company which is sustainable for the long term. For 2019, the macro backdrop items which are influencing our investment decisions are the capital markets in Canada, and specifically in the Canadian energy space, currently are challenged. This is not a market where we want to put ourselves in a position to require external financing. The Canadian energy industry as a whole is facing egress challenges, which suggest near-term production growth is not prudent. As previously highlighted, our company's been proactive and secured egress solutions in support of our longer-term growth ambitions, but the equity market, given those broader egress challenges, is today not paying for additional production growth. Western Canadian basin pricing has been challenged, and this has resulted in the Alberta government mandating production curtailments, which impact some of our primary condensate customers. While this has had no impact on our ability to move our product, it has introduced an additional layer of temporary pricing volatility. Our strategic priorities in that macro environment are, first, preserving our balance sheet, two, continuing to seek additional and diverse long-term markets for our products, three, maintaining our productive capacity in the most cost-efficient manner so that we're able to respond when the macro environment improves. Maintaining and not seeking to grow current production preserves our drilling inventory for better pricing days ahead. And four, investing to enhance our options to capture value when the macro does improve. To speak to those priorities, our balance sheet is currently in great shape, and our 2019 plans would ensure that it remains so. We target to maintain a debt to EBITDA ratio of less than 2 times. At a $50 WTI plan, $50 WTI, we would expect to exit 2019 at a 1.8 times ratio, improving to 1.2 if we live in a $60 world. More important to me than that ratio, planning a self-funding budget for 2019 would mean that we would exit the year with our $1.4 billion bank line undrawn, which offers us ample liquidity. Further, we have no debt maturities until 2023. Our liquidity position and balance sheet capacity is very robust under these 2019 plans. To further bolster our financial position, we maintain an active hedging program. We do not hedge as a speculative tool. We hedge to reduce the volatility of our cash flows and to guarantee funding for a significant portion of our capital program. For 2019, we're well hedged with about 40% of our WTI exposure contracted between $62 and $78 Canadian, and about 50% of our natural gas exposure contracted at $3.48 Canadian. As you know, the TSX approved the commencement of our normal course issuer bid late in 2018. We see buying our shares as an investment opportunity which may enhance our per share net asset value. When we evaluate applying capital to accelerating growth versus investing in the NCIB, there are certain combinations of capital efficiency metrics and share price where an investment in growth capital enhances our NAV at the same rate as buying back our shares. When we make those comparisons, we do not consider the impact that our other value-enhancing projects, including inventory delineation, can have on our NAV. And should those investments generate the returns we expect them to, the NCIB enhances our per-share exposure to the upside from those results. As a side benefit, the NCIB can be a lower risk and at times lower cost way to deliver per-share growth metrics in a way which does not consume drilling inventory. We will continuously be evaluating that opportunity in relation to other investment opportunities. Our prior investments have positioned us well to prosper in a softer price environment. In 2019, we're planning to invest approximately $500 million less than we did in 2018. We're able to sustain our productive capacity at that much lower investment rate as we currently benefit from previous infrastructure investments, improving capital efficiencies, and mitigating decline rates. Should prices improve in 2019 beyond our $50 assumptions, we have significant visibility to near-term free cash flow and the investment optionality that cash flow could offer. After that very long preamble, the high-level summary of our 2019 budget plans are: we plan to invest $1.25 billion into our business. $1.1 billion will go towards sustaining capital, which will deliver an annual average production rate of 200 to 205,000 BOE per day. We expect about 59% of that volume will be liquids. We'll also invest $150 million of discretionary capital to add long-term value through delineation, water handling, and the building of some modest infrastructure. The majority of our sustaining capital investment, $780 million, is directed towards our Nest 2 area. Nest 2 continues to be the core of our productive capacity, and the high rate of return opportunities there will continue to contribute high-value condensate volumes to our production stream. Our Nest 2 plans include investment in supporting infrastructure, including field gathering capacity, super pads, and notably field compression and debottlenecking for production optimization with a view to helping manage decline rates. The balance of our sustaining capital, $320 million, is allocated to our Nest 3 and Nest 1 development opportunities. As Chris will speak to later, we see opportunities to essentially recreate the Nest 2 economic results through a blend of Nest 1 and Nest 3 activity. Much of this activity will target production in the second half of 2019 and early 2020. We're planning to invest $125 million in a variety of opportunities which will further enhance our understanding of our asset base. Lynn will expand on these comments later in a way that's likely more compelling than I will, but for some context. As we've talked about previously, we believe we've got more than 15 years of drilling inventory currently identified in our core Nest areas. We do not have an immediate need to add inventory. So you may ask yourself, why would we invest in delineation funds in a capital-constrained year? With our Q3 results, we recently announced an encouraging Lower Montney test result. If our further delineation efforts in 2019 are successful, it's likely that the most cost-efficient way to develop going forward is a triple stack well design, which completes the upper, mid, and lower Montney concurrently. Delineating the lower in 2019 may well put us in a position to enhance our future capital efficiencies by leading to that concurrent development. We're also doing some modest drilling in the Wapiti and Nest 3, partly to manage land expiries, but more importantly to evaluate liquids ratios in the Wapiti area and try and determine the rich gas boundary for Nest 3. Expanding this boundary has a potential to extend our inventory of high-quality drilling opportunities in Nest 3. Finally, we're also drilling in Nest 1 to follow up on some encouraging results that some of our competitors have had in adjacent lands. We believe that we can improve our Nest 1 type curve beyond our current expectations based on those competitor results. Our current operating cost profile is below the curve, i.e. better than the majority of our peer group when you consider the relative liquids weighting of our production base. We're investing $25 million in 2019 to further improve our operating cost performance by drilling an additional water disposal well and adding further water handling capabilities. Before I leave this slide, I want to make the point that for 2019, we're investing $150 million in projects that do not directly lead to immediate production adds. As Marty said, if we had invested those funds in growth, we would likely have increased our BOE growth by about 6% in 2019 over our current projections. In this environment, we prefer to moderate our growth, preserve our inventory, allow corporate declines to mitigate, and invest in ways which will add long-term value for our shareholders. We're investing for long-term economic returns, not for BOE growth. With that, I'll turn the mic over to David.
All right, now on to the good stuff. Good morning, everybody. Hey, thank you for coming to our Investor Day today. My name is David Holt. I'm 7 Generations Chief Operating Officer. I've been with the company since May of last year. I bring 27 years of predominantly operations production experience to the table. Since I've been here, probably the number one question I get asked all the time is, what have you seen so far? And what are your first observations? There we go. So first of all, this is truly a world-class asset. I've worked all corners of the Montney Reservoir, from Kakwa to Pipestone. I've worked Tower, I've worked Septimus, all the way up to Begg in Northeast BC. I can truly say that we have an excellent. Sorry, I got too far ahead here. I can truly say that we have an excellent asset here. It's liquids rich, high pressure. That's perfect for development. We have a truly talented workforce who are motivated to deliver what they promise. Safety is a core value. It's embedded in our culture. It's embedded in our company. Our motto is safe production is number one. So safety always comes first. We have a robust infrastructure network capable of carrying large volumes of gas and liquid at high pressures. Most importantly, the operations team are dedicated to what they're doing. They never stand still, and they have a continuous improvement mindset. That being said, we have to deliver what we promise. I've broken down our operations into 3 focus areas for our teams to deliver excellence: execution, optimization, and cost control. I guess you could say this is the engineer's version of a 3-legged stool. These are 3 very simple concepts with a profound impact on how we do business. They represent our planning, our accountability and our responsibility, our dedication and discipline, and our adaptability. All of these are supported by a foundation of a safe work environment for our staff, our contractors, and our vendors alike. These are our core values, embedded in our culture and defined in our actions. For 2019, our execution plan was driven by a grassroots, team-based approach, driving ownership and accountability to the plan. Our goal was for a repeatable program in drilling, completion, facilities. By driving for this, it allows us to be efficient, streamlined in our operations. It allows us to be disciplined but adaptable to changing forces and circumstance. And it allows us to make our volumes, control our costs. For example, our 2019 drilling rig fleet is much flatter than in years prior, resulting in a smoother, more predictable program across the board. Not only does this allow us to be selective with our vendors, but by using the same vendors, we make them more efficient and more cost conscious. It also results in a flatter production profile, meaning our infrastructure operates more optimally. Seven Generations has already detailed out our 2019 drill program, identifying not only our vendor requirements, but setting the timing for our plans. We know exactly where, when, and how we're going to drill, complete, and bring on our new volumes in 2019. This schedule was set by the teams themselves, meaning they are bought in and committed. We already know today how we want to complete a well in September. We already know how to minimize the impact to our base production. At this point, it's all about making it happen in a safe environment. Sorry. There we go. This past year has seen a significant improvement in our completion designs. While we have generally left the volume of sand in place the same, we've reduced the sand tonnage per stage, but increased the number of stages per well by about 50%. Sorry, I lost my spot there. From approximately 40 to 60 stages per lateral. This method better stimulates the area close to the well itself, ensuring maximum recovery of hydrocarbons, minimizing the impact to neighboring wells. Our modern fracturing standard, in conjunction with the use of cemented liners, mitigation techniques, wellbore placement, has significantly reduced the parent-child effects that we've witnessed in the past. Seven Generations completion design, coupled with a well-thought-out execution plan, allowed us to expand our competitive bid process. We were able to approach more vendors with a solid plan, and we are expecting savings of approximately $600,000 per well over the prior year in completion costs alone. Excessive downtime is an easy way to erode value for any company. The changes to our development techniques is allowing Seven Generations to keep more wells online during operations, as shown by the orange bars on this graph. Coupled with improvements in facility runtimes, minimizing individual well outages, our field operations have successfully dialed back our downtime impacts, driving additional shareholder value from our base volumes. Seven Generations continues to develop our Kakwa River project. Attention to our base production becomes more impactful to our business. Every year, we add approximately 80 wells to our inventory. By 2020, most of our production will be from legacy wellbores. While it's perfectly normal for engineers to want to bring on a 3,000 barrel a day well, we cannot discount the importance of several hundred 200 barrel a day wells. Renewed attention is being paid to our legacy assets to drive value by optimizing our base production. Optimization efforts in 2018 included strategic compression, artificial lift applications, and wellbore interventions. Our most high-profile optimization work has added over 4,000 BOPD to our base production at a capital efficiency of less than $3,000 per BOE. We have realigned our technical staff to ensure appropriate attention is paid to our legacy assets, driving our optimization initiative. The ultimate result of active optimization is stabilization of our base volumes, reducing our corporate decline and providing cash flow to the company. A true inflection of our base volume productivity was witnessed this past year as a result of our optimization efforts. A well-designed and well-thought-out execution plan yields benefits in other areas as well. Being able to identify our vendor requirements up front and ensuring stable business to the vendors It has allowed us to aggressively bid out our contract work for the year. To date, we are seeing a 9% reduction in our capital costs over 2018 simply by engaging good supply chain practices. Seven Generations has invested significantly in our water handling capability and efficiency. Over the last 2 years, we have added 4 owned disposal wells, gained access to 1 infield third-party disposal well, and added significant infrastructure to mesh our operations with our water handling system. Seven Generations is actively increasing the use of recycled water in our completion activities. We have used as much as 30% recycled water on recent completions, reducing the amount of fresh water required for a pad completion by up to 16,000 cubic meters. We have invested just over $100 million in the last 2 years, reducing our operating costs by $1.30 per BOE and paying out our capital in well under 18 months. 2019 will continue to see discretionary spending on additional water infrastructure. These efforts not only reduce our operating costs, but by integrating the water and the operation systems, they remove trucks from our roads and our highways, reducing wear and tear on our infrastructure and making it safer for our people who use those roads. All these initiatives are rolling up to one thing in mind: deliver what we promise. Through this program, we are going to execute appropriately. We're going to deliver our costs, we're going to deliver our volumes, and we're going to deliver shareholder value. Now I'd like to ask Chris Felton, Lynn Krumka to come up and present our next section.
Thanks, Dave. And again, welcome everybody today. My name is Chris Felton. I'm VP Corporate Planning with Seven Generations Energy. And I just thought I'd step you through for a few slides here in terms of what our philosophy is from the development perspective, not only in 2019 as it relates to the budget, but also looking over into the next couple of years. So priority one with the 2019 budget was to continue to extend the Nest 2 development. We have greater understanding of our CGR trends. We've talked about that previously in 2018. We're going to follow up with some drilling in Nest 2 West, where we saw some good results in last year, 2018, and begin to step into our Nest 2 East lands. So we'll get to a map, but these are lands in the eastern portion of Nest 2 that we haven't really developed yet. As in prior years, we really do try to focus development where we can leverage capacity at existing super pad infrastructure. So priority always goes to where there's excess capacity, take advantage of that sunk capital that's been invested, and really try to focus on maintaining our strong capital efficiencies. Secondly, and this is the big one for 2019, is we're going to integrate Nest 3 into our core development here. So this includes boring 4 key pipelines under a river to get down to Nest 3, high pressure, low pressure gas, a condensate line, and a water line. Natural gas volumes will ultimately be used to move up towards our Gold Creek plant. Growth out of Nest 3 will only materialize later in in Q4, Q3 2019 and into 2020 beyond that. The third objective is to enhance our Nest 1 understanding. This is a big area for us. We've done really limited drilling in this area to date, but we did start to step in here in 2018. We brought in a 5-well pad, a 12-well pad back in about June or so, and then we've drilled the southeast wells off that same pad. It's another 9 wells that we completed just before the end of the year, and those are just ramping up here right now. So works out to about 26 wells that we've actually done as our first development into Nest 1. And we'll be delineating the outer boundaries of Nest 1. We'll get into that in a bit, but it's to really prove up and confirm the deliverability of that play. Fourth, we're going to be dedicating capital to expanding this inventory. I think you've heard this from a few people already today. The lower Nest 1, a little bit into Wapiti. The big one for us here is really the lower. Keep reminding everybody of this. The lower, we don't have anything in our reserves or limited contingent bookings in the lower. So from an inventory perspective, this really is one that's going to move the needle for us. In terms of Nest 3, just to dig into here a little bit, It'll make up a considerable portion of our investment in 2019. This follows on our active focus on Nest 1 from 2018. So condensate rates from Nest 1 were well ahead of our previously disclosed 2014 type curve. Nest 3 is kind of the opposite. We've talked about this in the past, but we did drill and complete 2 wells down in Nest 3 in 2018 that came in pretty much in line with one of the best wells that we drilled from a gas perspective back in 2018. Condensate gas ratios are lower in Nest 3, but there's much higher gas associated with it. As a result, the aggregate condensate rates start to compete and look like some of our pads in Nest 2A. So, lower CGR, but it does that gas does drive high aggregate condensate rates. So with this in mind, we've kind of looking at Nest 1 and Nest 3 development as a bit of a formula now where 3 + 1 = 2 × 2. So you take one Nest 3 well, one Nest 1 well, and it kind of looks on a blended basis like 2 Nest 2 wells. So what this provides us from a corporate perspective is the ability to bring on pads from Nest 1 and Nest 3 that really do kind of mimic from a corporate perspective what we were getting from Nest 2. And as a result, from a strategic perspective, we can start to blend and make sure we're getting the corporate level commodity split that we desire. And this is a follow-on to some of Dave's comments, but this is a really important one. Our development strategy is really a team-based approach, and I think it's much more that going into 2019 than it has been in the past. We treat each pad as a project. Each one has its individual economics. Each one can be up to the size of a small E&P company in and of itself. From reservoir through facilities, through marketing, the teams have input into the design parameters for every pad. This includes drilling completions, obviously, but also pilot studies that we're doing, artificial lift strategies, what's the proper surface facilities that we should be investing in each of these things. All of these aspects are going to be tracked and monitored, and then we can evaluate these. We look at the pad economics on essentially a full cycle basis in terms of IRRs, NPVs, profit to investment ratios. And then with the actual production results and the actual cost, we can monitor whether our expectations are being exceeded, whether returns and NPVs are better than expected, and importantly, any design changes that show promise, we can thus implement into our designs going forward. So with a robust inventory of development pads covering a wide variety of CGR natural gas producing regions, we can adjust our development to meet corporate objectives. Our pad technical summaries also serve as an internal scorecard for our execution. So how did we do relative to what we were expecting from each of those pads? I'm going to take, I know Derek dove into this quite a bit. I just want to spend a little bit of time here specifically on the delineation side of things. And if there's one message from the delineation side that I think is important for 2018, you delineate when prices are low and you develop when prices are high. So those of you that are familiar with our Nest 2 development, a lot of our development has been in the kind of the core, the central part of Nest 2 to date, kind of an inside-out development. As a result, we're just starting to get into Nest 1 and down into Nest 3, but we are pushing the boundaries. Towards the west, we did have some success in what we call our Nest 2 West area there, kind of in the tan pinky region there towards the west. Some of our initial wells that we drilled in 2018 were pretty decent CGRs, and it was sweet. With success here next year, we're hoping to potentially push the boundaries of Nest 2 West outwards. Towards the north, actually let's jump to Nest 1 because this is a really important one. Those 26 wells that I talked about last year were sort of in the middle part of Nest 1 there. But our competitors have been getting good offsetting rates kind of all along our offsetting boundaries. So we are going to go towards the east with some delineation wells and up to the north as well. And really this isn't so much about showing that the resource is there. I think between our wells and the competitor wells, we know the resource is there. It's more about defining the product mix to make sure that we're coming back with a development plan that has the optimal artificial lift, well designed, surface facility when we get into the full development. And then down, well, actually, I'll just let Lynn get into the lower, but we are looking at expanding that to the south as well. So just to reiterate where we've been and where we're going, In 2018, we accomplished the following. So we stepped into Nest 1 with our first 2 development pads using our current completion designs. We gained a greater understanding of our CGR variations within Nest 2. We invested in water handling infrastructure to reduce operating costs. Dave talked about that. And importantly, we made the decision to move away from open hole completions, and we're now almost entirely cemented liners. In 2018, we'll be integrating Nest 3 and bring on our first development pad from that area. Nest 3, this is an important thing to kind of note and highlight. We first identified Nest 3 in 2017, went back with a couple wells, and now we're ready to go into full development into that area. And it was a big stepping stone for us, even just defining Nest 3, because the old curves that we had for that area weren't super compelling. But as we went in there with better completions, the results look quite attractive. So that is a big accomplishment for us. And then, sorry, I just got to get back in my spot here. Confirm Nest 1 deliverability, we talked about that, and then test the lower Montney. Looking into 2020, we'll continue to grow our Nest 3 volumes. We'll return to Nest 1 with some drilling, pending results. Where we ultimately go, we'll probably be reflecting, with the results that we get here in 2019. But Derek hit on this importantly too. Like with success in the lower Montney delineation this year, we ultimately see that doing the upper, middle, and lower is going to be the way to do this. And this is huge from just expanding our inventory, but reducing the pace that we're having to step out each year. And going in that 3-stack development just extends that development timeline that Marty had talked about. So as you've heard earlier today, growth is an output, not an input. Our strategy with 2019 is to define more inventory with our program while increasing the value from our existing inventory and executing the 2019 development program as efficiently and safely as possible. So with that, I'll pass things over to Lynn, who will get into more detail from our 2018 results and our 2019 plan.
Thanks, Chris. Good morning, everyone. My name is Lynn Krumka, and I am Director of Geosciences. There we go. So we have to have rocks at the front of my slides because that is the most exciting part of this area. Over the next few slides, I'm going to go into some detail on the development plans we have for 2019, specifically over the Nest area, as well as our plans for Lower Montney and the Cretaceous opportunities. In 2018, we integrated a number of subsurface technical data sets in order to better understand our reservoir. We acquired a significant amount of 3D seismic data that now covers most of our acreage. Through seismic attribute analysis, we can be more predictive in identifying reservoir parameters, pore fluids, and rock properties. This, along with core and petrophysical evaluations, geological mapping, including condensate gas ratio and methane migration mapping, and calibrated with production, we've been able to subdivide the Nest 2 development area into 4 sub-areas with variable CGRs, Nest 2 North, East, South, and West. In 2018, we also performed a microseismic program on a superpad in order to get better understanding of our frac geometry. Our learnings from that program are helping us optimize our frac design. We have used all of the subsurface technical data to build a 3D reservoir model which supports our development planning. Focusing on Nest 2, the map on the left shows the 4 sub-areas that I mentioned earlier, north, south, east, and west. And as I mentioned in the previous slide, the sub-areas have different condensate gas ratios, and these are reflected on the CGR versus time chart on the upper right side of the slide. The color of each CGR curve corresponds with the sub-area color on the map. Also on this chart is the 2017 Nest 2 CGR type curve prior to subdividing the Nest 2, shown in the black dashed line. As you can see, 3 of the sub-areas show higher CGRs than this curve, with the north having the highest CGR and the south area being gassier. Overall, as shown in the table, we see the higher end of the range for condensate at 38% in Nest 2 and the lower end of the range for gas at 40%, with CGRs of over 155 barrels per million cubic feet. The map also shows in green our planned 2019 activity, And as Chris has already mentioned, as we move west towards Wapiti, we anticipate the 100 barrel per million line, shown out as a dashed line, will move westward, thus expanding our highly economic Nest 2 area. As Derek and Chris have both mentioned, we are planning to advance development in Nest 3 this year. And part of the investment will be expanding our pipeline system to capture the forecasted volumes we expect by early 2020. The area continues to outperform our expectations with higher condensate volumes primarily due to the high gas rates this area delivers. As shown in the chart on the top right, the average cumulative condensate per well is approximately 85,000 barrels after 6 months. These wells have strong economics, and it's an inventory in our portfolio that provides optionality to blend with even higher CGR areas. As we delineate further south in 2020, we may be able to expand the boundary of Nest 3 in that direction. With the latest drilling in 2018 in the center of our Nest 1 area, and you can see it with the just north of those green laterals, that's really where we have our results in Nest 1. These rates outperformed our forecasted 2014 condensate type curve shown in the chart in the top right. Based on our 2018 results, with significantly higher condensate production than the 2014 data, the economics have improved significantly, with our CGR estimate increasing from 135 barrels per million to almost 500 barrels per million cubic feet. We see IRRs above 80% and tripling of the NPV. We have an extensive area within Nest 1 that we plan to further delineate in 2019, both to the north and to the south. And just as with Nest 2, gas migration fairways within Nest 1 exist. This is supported by the offsetting operators' results. The pink stars represent competitor wells that flank the eastern edge of the Nest 1. Their resulting production shows variation in condensate percentages ranging between 44% and 68%, with the lower percentages corresponding to gassier areas. We're excited about our delineation plans since many of these competitor wells exceed our 2018 Nest 1 results. Another area that we are excited about and you've been hearing about is our Lower Montney. The Lower Montney has significant upside across our acreage. In 2018, we drilled a partial stack test which included 1 Lower Montney, 3 Middle Montney, and 3 Upper Montney wells. We got very encouraging results with our IP90 rates of 1,050 BOE per day, 72% of which is condensate. With this success, we are moving forward in 2019 by drilling additional stack tests of Lower Montney wells with Middle and Upper. Our triple stack test is shown in the schematic on the right. It represents a half section where we are drilling 3 Lower, 3 Middle, and 3 Upper wells. This is the first test in our area that will have bounded wells in each Montney layer. We will be delineating the Lower Montney with both partial and triple stack tests within Nest 2 and Nest 3 areas, shown by the red stars on the map. Through these tests, we will focus on further optimizing our completion design for the Lower. Furthermore, by developing the Lower Montney as a full Montney development stack, we achieve higher capital efficiencies while maximizing our resource recovery. A vertical test on the west side of the map in the Wapiti area also gave us encouraging results, with the gas and condensate volumes produced out of the well over a 5-day test of 2 million cubic feet and 160 barrels respectively. This is a commingled Lower Middle Montney. However, we believe most of the production is coming out of the Lower as it has better porosity than the Middle at this location. As we delineate this year, success in these Lower Montney tests can lead to hundreds of potential locations. In the Cretaceous, we see Cretaceous as an upside opportunity. The Cretaceous Spirit River exists above the Montney, which is shallower and lower cost to drill. Taking advantage of Montney infrastructure, we can drill for this resource with access to premium markets. In 2018, we drilled 2 horizontal wells with IP30 rates of approximately 6 million cubic feet per day, which are operationally restricted due to offsetting high-pressure Montney production. This resource is a potential source for gas lift or EOR for our Montney. It provides an opportunity for us to use dry gas rather than our rich Montney gas for these operations. Enhanced recovery is something we're studying, and we'll continue to monitor industry advancements in this area. Obviously, this opportunity must compete with the rest of our portfolio. However, we see up to 190 locations of upside potential. Overall, our economics remain robust in the Nest area despite a lower commodity environment, averaging IRR of 185% in our liquids-rich Nest 2 area. We see upside in both Nest 1 and Nest 3 as we delineate in 2019. Our Nest area has a remaining inventory of nearly 1,300 premium upper and middle Montney locations, and additional opportunities exist in the lower Montney, Wapiti, rich gas areas, as well as the Cretaceous. I will now pass the presentation back to Marty for some final comments.
All right, so just one more look at the takeaways for this year. We've talked a lot about expanding our inventory. We already have a top-tier inventory, a large top-tier inventory, but we're working hard to expand that to improve the sustainability of the company. We are delivering what we promised. 2018, we hit our targets, production, capital, and others. We have a diverse marketing portfolio, which does give us differentiated pricing. As I said earlier, we are getting U.S. dollar and U.S. company type pricing for our products with Canadian costs. And again, financial strength, flexibility, and liquidity. So a strong company. We appreciate you taking time to be with us here for this Investor Day and being on the webcast to listen in. And we really appreciate the shareholders that are with us too. We're going to open it up now for some questions, and I'll invite the team to come up and join me to help me with the answers. When we've got some mics that we can pass around in the audience, I'd ask you to state your name first. We are being webcast, and that will help with the transcript. So as we assemble, we're open for questions. Any come in on the email, Brian? Okay.
Trent Bain from GMP First Energy. You had a very significant decrease in your spending and allocated a much smaller amount of capital to your sustaining capital forecast than we had budgeted at our firm. I was curious, though, what your DUC inventory was at the end of last year, and as we go through this year, what your DUC inventory will be at the end of this year.
Yeah, thanks, Trent. Good question. And so I would state first that we don't have a deliberate intent to kind of carry forward wells from one year to the next. In the way we drill with batch drilling, often we're drilling 6 or more wells at a time before we'll even come back and complete wells. We often have a lot of wells in process or in progress before we get the completions done and get the wells on production. A ballpark of the number of wells that were in process from year-end 18 into early 19, it's about 30 or so. We're anticipating fewer coming out of this year at this $1.25 billion capital investment plan. Targeting around 10 coming out of this year going into next year. To live within that, well, look at it, I'll say we're actually targeting a higher number than that. We're targeting to get more done for that lower capital level. So our ideal budget investment would be a little higher than this. We'd like to get a little more stuff in process. We want to get a more level loaded program that will make us more efficient and safer, all the important aspects of how we do our business. So we're targeting probably a drilled uncompleted inventory similar to what we had at the end of 2018. But if we don't make as much progress as we want in terms of getting more done for less money, it may be as low as 10 coming out of this year. Thank you, Trent. Well, we must have explained everything really. Oh, good question coming up.
Brian Bagnall at Macquarie. You talk a bit about how your decline rate is going to come down as a function of you guys kind of holding flat this year. I was wondering if you had an estimate of what your corporate base decline rate is this year and what you would expect it to be entering next year on a hold flat budget.
Thank you, Brian. It's a great question, and obviously it goes to our sustainability. So the lower the decline, the lower the investments we need to sustain production, therefore the more discretionary or free cash that we'll have available. Look, I don't mean to be evasive, but it's a difficult number to pin down. Part of it is, in fact, we've been pleasantly surprised at how some of the optimization work that David and his team have been doing, we've been pleasantly surprised how that has mitigated the apparent decline that we had seen earlier in 2018. I would say it's still of the order of mid-40s. How much do we mitigate through the year? Obviously, a big impact is going to be the flat production profile we intend in 2019. That alone will mean that there's fewer new wells dominating the decline. That alone will bring down the decline rate through the end of the year. But the continued mitigation optimization work that David and the operations team will do will also help. Our guess is that it's probably going to come down 2 to 3% through the year, but we can't be sure until we actually get further along. But a great question.
Hey guys, Jordan with TPH here. I just wanted to ask a bit about the operating costs. Obviously a pretty substantial reduction through 18, but I think if I remember right, the original guidance was 450 to 5, and so the 19 guidance comes in a little bit above that. Just wondering if you think below 5 is still achievable and kind of how you get there.
I'm going to share this answer with David. First, I would say, look, it's our intent to be as efficient as possible. In 2018, we had a lot of opportunities to get more condensate on production, some of which involved workover expenses, which we expense, and so they go into the operating costs category. They add to the operating costs, but if you can get those workovers done and turn on more condensate and sell it for $70 or $80 a barrel, it makes sense. I mean, those you got to think about the netback more even than you think about the operating costs. To go back in time, we had actually deliberately deferred investment in water handling infrastructure in our 16 program, our 17 program, and we didn't really begin to get a lot done on the water handling side until late in 17, and again quite a bit through 18. As David said, we've invested more than $100 million now in water handling, which is intended to help with the operating costs. Operating costs are a third to a quarter. I mean, water handling is about a third to a quarter of our operating costs. So we've made progress on it. We're planning a target that is a little higher than the target that we had set for 17, the $5 to $5.50. And I'll ask David maybe to add to why we've got that range and what you intend to do in terms of the operating costs in 19.
Yeah, I think the big. Sorry about that. So I think the big thing with our operating costs here going forward, the water mitigation has been a big influence on managing that water or that operating cost number. I think going forward, we focused a lot on, I'm going to call them the big rocks, so the capital savings, and a lot of the big operational efficiencies that we're gaining that have a direct and indirect impact on our operating costs. If I look forward 2, 3, 4 years, do I think we can challenge that $5 number? Absolutely. We're currently right now we have a lot of our operations basically under control for next year. We're actually kicking off a very focused effort into looking into the details of our operating costs down to the nickels and dimes and the dollars per liter for chemicals and how much we pay for fuel and all those little tiny pebbles that all add up to big rocks in the long run. So with what we're doing next year, I think it's appropriate where our op cost level is, but I definitely want to challenge it down the road.
Yeah, great question, Jordan. And I guess I would just add to it with just a reminder of what Derek had presented. Really, when you consider the liquids content that we have in our BOE, our OPEX is actually significantly below our peers for this level of liquids that we handle. But we're going to strive through that great work that David and his team are doing, strive to get even better. So thanks, Jordan. Yeah.
Hi. Chris Maurer at CIBC. Speaking specifically about the Gold Creek process, would you consider an outright sale, or you mentioned you're looking at it as a revenue source or potential partners in that facility? And then how do we think about the base facilities? Is that something that you also look to monetize, or is that sacred?
Yeah, I'm going to share this answer with Brian. Brian's the one that's been leading the process for us. First thing I would say is that we've always valued operating our own infrastructure. I think that would be still an important thing for us. So to the part of your question regarding would we sell the whole thing, that's not a driver for us. I would go back to the beginning of the process and then ask Brian to elaborate on where we're at today. But at the beginning of the process, it was a bit of a different environment. In fact, our share price was substantially higher. We were at a point where we recognized, and we've known for some time that we've got a processing plant that's nearing completion and we've got excess processing capacity available. Can we take that and turn it into an alpha revenue stream? And so that was our initial intent. It was to open up that process for getting a partner perhaps at Gold Creek, finding a way to take one-on-one, our plant, somebody else's idea, and turning it into a three. So that was what we intended. From the time we initiated that process until now, our share price is off a lot. Makes it a bit more intriguing to think about taking more capital and applying it to a share buyback, for example. So the potential has changed, and maybe I'll ask Brian to give an update on where we're at with that process.
Yeah, so we did kick off the process in Q3 and then have formal proposals on the table that kind of came in late December. So we're in the process of working through it right now. Tough to give too many specific details just given the CAs that we have in place. But I think just from a high level, there, as Marty mentioned, there's a significant amount of intriguing optionality. Everything from taking a look at a bigger transaction, as Marty mentioned, to making it Gold Creek specific. And the counterparties that we're just in discussions with each bring something unique to the table. So I think it comes down to us sitting down with our management team and with our board and say strategically what makes most sense for the business. But as Marty mentioned, there's a wide range of opportunities ahead of us, and we'll continue to pursue those discussions, see what makes the most sense.
But Chris, your great question allows me to maybe expand on why we like to control. Like one thing is that we're really pleased with our execution in that construction. So that this last plant came on time and significantly ahead of budget, just as our previous two plants did. So we've been able to build the plants efficiently. They process. We've actually tested the new plant, the Gold Creek plant, to its capacity, and it's performed extremely well. In fact, I was out there just before Christmas, and the guy said it was one of the smoothest startups, touch wood, one of the smoothest startups we've ever had. So it was outstanding. Performance and execution in the construction was great. It processes what it's supposed to. I think we can build them as efficiently as any midstreamer, and I believe we can operate them as efficiently as any midstreamer. So it all goes to, do you take that investment, which is significant, and convert it into capital, or do you continue operating it, controlling it, keeping your fees, your operating costs low? It would all go to what's the use of proceeds, and so that's part of the evaluation that's underway. We expect to have some news on that by mid to late February.
Patrick O'Rourke, AltaCorp Capital. Just wondering, a year ago you were talking about 55% liquids cut in 2019. You highlighted that earlier. Now we're at 58 to 60%. Just wondering, is the driver of that higher initial liquids cuts, or in the past we've talked about leaning of the liquid stream, specifically condensate, through time? Is that outperforming expectation? Sort of what's the interplay that's going to drive that, and how durable do you see that in the future?
Great. Yeah, thank you, Patrick. A great question. Look, there's a few things that are feeding that, and it does remind me that I want to emphasize too that when we put our program out for 2019, this year, we're still projecting about 75,000 barrels per day of condensate in 2019. Back on November 16th, 2017, as we kind of thought about what 19 would look like, we were also projecting 75,000 barrels per day of condensate. So that hasn't changed, even though the BOE number, including some of those empty calories, that BOE number has come down. We're still going to get about the same condensate. So why are we getting a higher condensate yield? It turned out to be about 59% in 2018. There's a combination of things. Part of it is the reservoir understanding, which allows us to be selective about where we put our wells, and we can target more liquids. I think probably even more important, we've got more production coming from Nest 1, which is richer. But also I think the evolution of our completion designs, where we've got a smaller per stage amount of sand going into each well, but more stages. So overall, the same amount of sand going into the well, but putting it in through more stages. I believe that's causing a better rubblization near the wellbore. The depressurizing that I referred to in my talk, the depressurizing is happening closer to the well, and therefore the condensate is coming into the well as opposed to being left behind in the reservoir. So I think those are some of the reasons we're getting the condensate yields up higher. We still anticipate, this hasn't changed, we still anticipate condensate yields reducing through time. We do see condensate falling faster on the decline curve than gas. But for this year and for the foreseeable future, we think that 58 to 60% number is the right number for the models. I think that's it for questions. I really want to thank you again for taking time to participate with us in our Investor Day, all those in this room as well as those on the webcast. Invite you to stay around and talk to management. We've got a bunch of our team in the back as well as those of us up front. And I think we've got some refreshments outside. So thank you very much for taking time with us, and thanks for being shareholders of 7 Generations Energy.